Okay, folks, good evening. Appreciate your patience today. Lots of distractions during payment season, so I, again, appreciate you guys being willing to not hound me about, where's today's video? So I just did the YouTube video, and I did that one not because it's more important for me to serve the general public, but because I want you to contrast the difference in what you're going to see here and what you learn here in Mentorship versus what I make public on YouTube. So again, this is not a complete treatment of price action for the cable, but you'll see that there's a lot of this core content is shown in here. And I want to kind of like revisit an idea I mentioned in our most recent commentary, talking about what the market was in terms of profile. The British pound has been in a range, and we did trade down into a BISI, just very shallow, like I mentioned we would, and we traded back up into the range. Since we're inside of a range, we want to look at concepts that would lend well with reaching below old lows and above old highs. And while there is a slight bias, very, very modest bias to the downside for cable, as you can see, I mean, we've been moving lower. Inside of this price leg, from this high to this low, there's a secondary price leg seen with this high to this low. Okay, so I want you to take a look at this candle's open, which comes in at 123.62 and 1 pipette. Okay, so we have our order block inside of this range from this low to high. If you look at that, that will give us the dealing range. This is what I was covering with my son this morning. I was teaching him the British pound London setup. And we'll put this out here as you can see. So the 62% retracement level we traded up into yesterday, and we traded above the 70.5 level. This candle here is what we're looking at. So we're looking inside of the range that was created from this candle, this entire candle right here. Now, for a moment, just ignore this candle. It's hard to do that, admittedly, but I'm going to try to accomplish it with this. Okay, so we have all of this right here. As soon as this candle closes, okay, once it closes, you have now created a BISI, buy side imbalance, sell side inefficiency. The market rallied up too much, covered too much ground in one single candle, and this is a daily candle. So we have to go back to the previous day's high, right there, and the previous, well, the day that it closed, that is our premium end of our BISI. So right away, this is the range I'm working within. So when we drop down into a hourly chart, and you can see we traded up into the optimal trade entry, that's this level here. This here is the 62% retracement level, the 70.5 level, and the 79% retracement level. And this is the order block, the bearish order block. You can see we traded right up into that there, and this is our premium end of the BISI on the daily chart candle, and this is the discount end of the BISI from the daily chart. So that one single candle we're looking at there. Okay, so now think for a moment. Okay, think for a moment. I'm going to take this Fibonacci off to clear up the chart. And again, this is hitting that bearish order block on the 26th, and then we had this drop lower and then run above. So it's running above the previous day's close. So the previous day's close is acting as what? A rejection block. Okay, so we have a rejection block in operation here? And if this does go down, what does it need to rebalance to? The previous day's high. Prior to this run up, remember the 25th? Okay, here's the 25th, the trading here, and this is the high of the 25th. All of this here is a BISI, buy side imbalance, sell side inefficiency. The fact that the market went above the previous day's close, that's your rejection block. We are inside of a daily optimal trade entry that's bearish, and the market should look to rebalance that entire daily candle or BISI, buy side imbalance, sell side inefficiency. And you see that happening here. Very, very, very precise. Everyone's data, if we were looking at like different data providers, the price on this particular candle would not agree with 1.2204 and 3 pipettes. It would be something different. Maybe a little bit lower, maybe slightly higher. You don't have to have the actual highest high and the lowest low. That's what my mentorship teaches you. It gives you the low-hanging fruit entry, and it gives you the easy objectives to reach for. It doesn't mean they're always going to hit. It just means that it's the easiest one to work with while you're developing. And over time, when you get more experience, you're going to learn how to build more trust and confidence behind the setups to hold for more precise entries or precise exits. And admittedly, my exits are always the weakest point because I'm never satisfied. I'm human. I always feel like I should have had more held and longer, unless it's a losing trade. Then I wish I would have had less. But anyway, the entire BISI's been rebalanced here. So now with that in mind, I want to take us back over into, this is what we saw in the YouTube channel. And while this is very, very good, I mean, this is extremely good. This is better than anything else out there in anybody else's trading courses. It's better than anything else on YouTube. It's absolutely burning down other trade educators because it's absolutely free and it's provable and it's happening every single day. They don't get every single day trade setups with their stuff on YouTube. It just doesn't happen. I'm giving you a formula to find this every single trading day. Now, this is, again, this is the lay audience presentation. In other words, this is what I use to get people interested in learning the things that I teach through price action and algorithmic trading. It starts with the rudimentary trade ideas of time and price as I teach it, and then now we're going to go into the mentorship level. Here is mentorship level. Now, again, everything here is not the complete treatment, but this is what even charter members are familiar with. They know how to see this. They know how to put it on their charts. They know how to work with it. I'm going to outline it now and remind you to go back to Twitter, and you'll see the live recordings of me calling this order block up to initially run above these relative equal highs and then above here, which this high is by itself is sufficient enough reason to want to go above that. But it's the Asian range that I'm targeting that you don't see on that video. The fact that we run through here and we do so with explosiveness, this high is enough. But above the Asian range high, and the Asian range high is 7 p.m. to midnight in New York time. That's what's being shown here. All of this is just standard deviations of the Asian range. All I did was get a measurement of the total range and then project that measurement down. It's, well, this is one. So one standard deviation down would be here, which is 2, 3, 4, and 5. The fifth standard deviation takes us down to 1.22, 1, 2, and 6 pipettes. Okay, and you can see that gray line. That's representing the line that's off of the Asian range standard deviations. The previous day's low here is in real close proximity to that. It's 1.22132 pipettes. So we're already less than 1 pip variance there. This darker line down here that calls a more significant low that's slightly lower than this but within 5 pips, and that's one of the things I guarantee in my content. I'm going to show you how to find the daily highs and lows within 5 pips. Now, why not perfect high and low, Michael? This is not as described. Believe me, there's critics in here that are just like that. And the fact that I have to have a 5 pip buffer is because, as I mentioned earlier, everyone's broker is going to have a slightly different price feed. Some of our lows are going to be a little bit lower than the other or higher than the other. And usually it's around 5 pips. Now, when I first started doing this with just Forex, in other words, 2006, when I primarily went just to Forex trading spot and not doing futures, not doing commodities, not doing anything else. When I did that, my buffer actually was 10 pips because back then there was a lot more discrepancy, but now they've really streamlined things and a lot of regulations have come into play, which is good. And it's allowed the amount of disparity across all brokerage firms to be minimized. Now, there's always going to be some measure of discrepancy between your broker and my broker and someone else's broker's daily low or daily high. That is reasonable. There's no reason for any of you to be bent out of shape over that. There's no reason for you to lose sleep over it either, because as you'll learn, and even in this example here, you don't need the absolute low. Now, you can forecast that just for your own mental trophy, but you want to be getting out as it's reaching for these objectives. You don't want to be holding on to, like on your last dying breath, it's got to get there or I'm failing. That's not how you need to be thinking or developing. It's not your goal. You want to have that as a forecasting goal. There's nothing wrong with that. There's a lot of times, I get the actual level high and level low, but in my actual trading, I don't really hold to that price point because it could fail, or it could go just right to it and then hold me into the next day if I elect to stay in that long. And that's something I generally don't like to do, even though sometimes it does pop forward and jump up to my level the very next day. There's times where you actually have to sit through a retracement that's a little bit more uncomfortable than I like to have. In other words, if it's reaching so close to my objective and I'm running short on time, and what is that? Like, you typically London close, which is what's being highlighted here, that time is 10 o'clock in the morning to noon. Okay, that's the sweet spot for me for targets being met. So there's several things that's in this chart that I want to talk about. And the original consolidation in here, we have the Asian range high. Above this high is going to be buy side liquidity, and below it is sell side liquidity. We're looking for, based on, as I mentioned on that daily chart, remember there's a potential willingness to go lower because we've shown a daily optimal trade entry that's bearish. So we're really pressed up high. We're in a premium market, and we traded above the Asian range high and above the initial high of the day. So when we have this drop down, it creates a small little area where sell stops could collect, and anyone that wants to go long, they chase this up here. They see a bull flag, and then it breaks down and breaks the relative equal lows here, running sell stops. When they do that, that sets the algorithm in motion to go higher. And when it traded back down into this order block, that's why I recorded it and sent it on Twitter. As it happened, it creates the order block run. This is your Judas swing. I drew your attention to right here without having to go all this, okay? And this run above the Asian range high, this is the run on Asian range buy side liquidity, and it's being purged. This breakdown and rebalance and consolidation and then displacement. When we have displacement, all you do is go in and look for the fair value gap. The fair value gap is this candle's low to this candle's high. So right in here, price goes right up into that, rebalances it. So this fair value gap in the form of a SIBI, sell side imbalance, buy side inefficiency, trades up into it here perfectly. What's the low on this candle? 1.2326 and 2 pipettes. The high on this candle comes in at 1.2326 and 2 pipettes. Again, the low is exactly the same thing as this candle's high. That is IPTA, the interbank price delivery algorithm. So even if you don't get this run here and it starts to break down, just wait for a fair value gap to form, and it forms here. It breaks the low and it comes back up. You can get a institutional entry drill right here. The institutional order flow entry drill. Let's say it right, Michael. And you could be short right on this candle's high. You don't need to actually go all the way up into this candle's low to get that ideal entry. And price does exactly what you would want to see. You want to see it quickly move away from it. It does. It trades one more time to this level right here, which is the opening at midnight. Okay, so if we're bearish, we want to see price trade above a pool of liquidity, ideally. Now, think about this, because I already know some of you are thinking, well, why can't you sell short here? Because it was above, because some of you already know what I'm saying or about to say. You want to be selling above the opening price. So above the opening price, what about this, Michael? Wasn't this a Judas swing? Well, it could have been. And it's going to sound like I'm cherry picking and form fitting, but remember, I had already showed you something in the London session as it happened and drew your attention to it. And I said, now log it and watch what it does. Everything I'm talking to you about now is in the context of what I was actually teaching my son and what I recorded and showed you on Twitter, which is the reason why I have this little asterisk here, see Twitter. All of this run here was initially running here, and then I wanted to see it run above here. The Asian range is what you want to see it run above. This little shallow run here didn't even really make a meaningful run above these equal highs. See that? So it left the buy side liquidity that was resting just above here and the Asian range, which it came back for later on after it created the optimal trade entry here. Now, I teach you in the mentorship how to trade the Judas swing if you want and do a reversal and get short. Or you wait for this. In other words, you watch this unfold, not participating in it at all. Wait for the run on the Judas, run out buy side liquidity. This is your power 3. The opening price. We're only interested in a run above the opening price, which is what you get here. And it runs above the 1.2350 or mid-figure level. It sweeps that, clears the Asian range buy side liquidity. It's purged now. Everything above this high and above the Asian range high, everyone's thinking it's going to go up. They're trapped now. They're all in here long. And now the market's going to do what? Unfold based on that daily optimal trade entry, which is bearish. Aiming for what? Yesterday's low. That's yesterday's low down here. Now look at the confluence of all these factors coming in. We break below the opening price, come back up one more time, retest it, do an immediate rebalance. This one single down close candle immediately rebalances here, then sells off aggressively, breaking this low. This low to high and the previous high, this is a breaker. It's a bearish breaker. That's what I'm highlighting here. Price trades up into that during the New York session. There's no optimal trade entry in here to work with, so we have to wait and see what happens. The market creates that little muddy decline, goes into consolidation. Now you can trade this here. There's nothing wrong with that, trading up into that fair value gap into the breaker. That's a pattern in and of itself. But I want to show you the amplification, again, and the mindset that would be trading with the model I've given on YouTube. You want to see that the clear displacement here, and then you can create that fib from this high to this low, giving you what I showed on that lesson on YouTube. It gives you that. But now, when we have a clear breakdown and we have a breaker and the market's reacting to it there, and we get an optimal trade entry and start to trade down, which one of these standard deviations do you look for it to reach to? Well, think about what I've given in free YouTube, that model using previous day's low. So what standard deviation of the Asian range lines up with the previous day's low? The 1.22, 1, 2, and 6 pipettes. Now watch what else happens. If you use a fib and you use this to get a swing projection, this is classic ICT swing trading. So all I'm doing is taking the fib, pulling it down from the high down to the low. Okay, so I'm using wick high, tail of this candle low. That's our range. Projecting that down, we get one standard deviation of 1.22081. Okay, see that? 1.22081. That's what you're getting here, that 1.22081. It doesn't really show clearly because I have it crunched up. There we are. Now you can see it. And the price of the actual cable market goes down to a low of 1.22043. Now remember, you have a confluence of several things around this price level here. Your standard deviation of 1.2212 and 6 pipettes. Then you have the previous day's low, which it has to go below That's the minimum criteria. You're looking for the trade to go below the previous day's low if you're bearish. And in coupling the previous day's low, the standard deviation, and a standard price swing, that if this high to the low is broken here, all we're doing is taking that distance from that low to high, and then, like, this is a fulcrum point. Imagine this is like a hand on a clock, and this is the center of the clock where it's anchored. This would just sweep all the way around until it touches down here. And that's all we're doing, is we're duplicating this low to high, which is simply a measured move. This movement is the same projecting down to here. That's what that -1 standard deviation is. And the market trades down into a time of day when it should create the opposite end of the daily range. And then it trades off the low and into consolidation towards the close of the day. So you have the opening. We don't get caught up in all this movement here. We're waiting for a run above. Now, I also know some of you are saying, I saw one person today tweet, someone's trading outside of the kill zones. What time is this down here? UTC -4. Okay, so it's accounting for daylight savings time. I could care less about daylight savings time. Okay, so when we see this time of day here, it's saying 5 o'clock in the morning. But if you do, as I teach in the mentorship, I ignore all of daylight savings time. I wish I could smack Benjamin Franklin in the head for even instituting it or even suggesting it, because it really makes it a problem. I don't care about having a little bit extra time because of the sun going up or down. It should be standardized. And that's what the banking industry does. They standardize that. They don't worry about daylight savings time. Okay, so that's why I say I don't care particularly about all of the shifting in time. I use, when I'm looking at price, this is the setting I'm actually looking at. This is before we spring ahead. Okay, this is our normal regular time. This is what I look at. And if you look at the low on this candle now, it's really only 4 o'clock in the morning with standard time, not daylight savings time. Okay, so hopefully that's cleared up a lot of uncertainty and why things are different and why they move around a lot. And let's go back to here. So, and obviously the New York session here is just a very generic time window between 8:30 in the morning when the news is released up to 11 o'clock in the morning when the London close occurs. So that sweet spot in time, we're focusing on continuation of what the narrative is in the London session. So overall, this was a really, really easy trading day. And I know some of you are like, well, how it wasn't easy for us because you didn't tell us in advance what was going to happen. And this is what you want to have. You want to have this information here. You don't want me just simply saying, do this because this is what I expect to happen. You want me to show you what these tools look like when they happen and how to expect it in the future. Otherwise, you're here wasting your time. You need to learn. Okay, and that's what my lessons, I want to gravitate to this more and not just prove like I've been proven for a long time now. I can pick the bias, I can pick the levels, I can tell where the market's going to go because it's been abused by a lot of people. And while that may not be what you want to hear, it will be replaced with a lot more substance and back the way it used to be when I first started the mentorship. All right, so that's going to be it, folks. Not a lot, but it's just one of those things you want to break down, you want to study your chart, and this is, again, without the fact that it's a candlestick, all of the lines, the candles rather, would be a line depiction on my part and in my journal, and I would have all the price and the time where each one of these turning points are. So I kind of like sketch out all of this, and then I just record it as such. I've always done it. I've been doing it like that for close to 30 years now, and like I said, it wouldn't make any sense to anyone else looking at it, even people in the mentorship. I get a lot of requests for it, and no, I'm not going to share it, but I might do one and just not put in the things I usually do from a personal level, because there's a lot of things like payment season for us in the mentorship is a little bit stressful for me because my staff get upset because some of you don't put the right payment note in, and you sometimes come back and say you did, or you did put it in the right way and it's wrong and it has to be refunded. So all those things, like today, it created a little bit of a hiccup today, and because we have a lot of new people that came in. Welcome to all of you, by the way. But when you go to payment 2, when you click in the month area in the form to watch the videos for month 2, before you go to that tab that takes you to where the content is, there's another tab that says payment instructions for next month. Every month has that, and that's going to give you the actual instructions. So that's what caused a lot of the delays today, because we were going back and forth with new students saying they did in fact do what we asked of them, and they didn't do it actually. But when I do journaling, I may have things that will be stressful, like maybe my son's about to have surgery again, or maybe I don't personally feel well, or there was recently a death in our family. And while it wasn't something I felt emotionally attached to, my wife did, and that is something that is bearing down on my psychology and view of how price is happening in the charts, because I'm distracted. I'm worrying about, am I spending too much time in the markets and not spending enough time working with my wife's needs or my children's needs? So that's what I'm saying. Like, I'm not trying to hide secret recipes to success. In my journals, I'm recording those types of things, and I'm just simply not going to make that available to all of you. I like all of you, but you're just not welcome to that level of my personal life. But I think I can do one in the future. Don't hold me to a date, because I don't know when I'm going to do it. But I'd have to do it outside of a time like we're doing now with payments. When we get in between payment seasons, every month there's like a 2-week period where we don't do anything with admin, and I might do that. I'll try to make room for it this coming month in June. But if I don't do it, don't get upset. I'll have it done before August. That's a fair enough time window. All right, so that's the business for tonight. I want you to take this chart, and I want you to really break it down, study it. And I already know some of you are saying, what is this indicator? Am I going to get this indicator? Okay, this indicator is nothing more than something I teach in the content that you'll learn about, and you'll learn all the levels in here too. I don't have the mid levels in. There's actually mid levels in here, but I just eyeball it. This keeps the chart real clean. But study it, how it has all of the turning points in here. There's a turning point in here. There's a collection of order flow in here, and it starts to build up into the close there, and obviously down into the low. So really interesting delivery of price on pound dollar today. I'm going to counsel you to go and look at the E-mini S&P. Now, I'm not going to do it for you tonight, but I told you that daily volume imbalance on the June contract. So the symbol would be ES, letter M as in Michael, 2020. That's what you would put up in here. Okay. If you do that, and for those of you that may be watching this video much later than the present time, you may not be able to see that chart, but the volume imbalance that occurs in our recordings around this time, you'll know what I'm talking about by that. I mentioned that if we trade above that volume imbalance and come back down into it, that would be bullish. And you can go and study the E-mini S&P, and you'll see that there's a really clear accumulation pattern that took place in optimal trade entries, bullish order blocks, bullish fair value gaps, all the things we look for institutional order flow created a really nice buying opportunity for index futures in regards to what I mentioned there. So that's some homework for you. Please don't tweet the chart to me. Please don't, send me charts in email. I don't need that. It's for your edification to study it. I'm quite certain I'll bring it up again on this weekend's commentary, because we're going to go back and touch again on index futures. Until then, I wish you good luck and good trading.